Yo, what is good, YouTube? We are back with another video, and in this video I'm going to be simplifying the draw on liquidity for you by using fair value gaps, because a lot of people are struggling with finding the draw on liquidity using ICT concepts. If you're not in the free Discord, go join it. It is linked down below, but let's hop into the video. So a lot of people struggle with this because they overcomplicate everything. A lot of people fail ICT because they overcomplicate everything. And in this video, I'm going to show you the easiest way to find the draw by using fair value gaps. Now, I like to use the hourly chart to find my daily bias, and then the 15-minute. Because I think the 4-hour and the daily are just too high of time frames, I will look at them at the beginning of the week to understand where the weekly candle wants to go. Because if you know the time frame alignments, you know the daily chart or the daily candle is complemented by the hourly, the weekly is complemented, or the 4-hour, no, sorry, the weekly is complemented by the 4-hour. And I like to use the hourly to identify where the daily candle wants to go. So right here, we see this hourly fair value gap. Right here at market open at 9:30, whenever we tap into this, right, we have a low over here. So what does that mean? This is where smart money likes to accumulate orders below old lows. So they're pairing their orders below an old low inside of a higher time frame fair value gap. Now, if the lower time frame, in this case the 5-minute, because the hourly chart is complemented by the 5-minute, we would displace through this on the 5-minute chart. Sure, the hourly candle could wick the entire way down here, but if we have displacement and strong displacement through this fair value gap on the lower time frame, that would show that the hourly draw would be this low or these lows over here. But in this case, because we held this hourly fair value gap and get displacement out, that is showing that the draw becomes this high, right? Now, on the hourly chart, right, we know that wicks do the damage, body tells the stories. If we were to wick the entire way down here and then close a body up here, we could then anticipate that the draw becomes this high. But you always want to be aware of what the lower time frame is doing. Okay, so right here, whenever we have this fair value gap, you want to go down to the 5-minute chart, because we know that the hourly chart, because I just told you, is complemented by the 5-minute. So right here, whenever we come down into it, notice we have displacement, right? Displacement are fair value gaps. So we have fair value gaps throughout here. So we have displacement into the higher time frame PD array. We have an old low right here. So smart money is accumulating orders. We do not reach that draw on liquidity. But if we go to the hourly time frame, notice what happens over here. We tap back into it. So we go back down to the 5-minute, and notice we have all these equal lows right here. We are pairing orders below them. Displacement out, we have a fair value gap here. Market opens right here. What do you notice? We come down here, sweep this low, and then we go to that hourly draw on liquidity. So whenever you come into the day on this day right here, because this is the overnight session, and we tap into this fair value gap, and we do not have displacement on the lower time frames through that, that is showing you that the draw on liquidity is becoming this high. Now, right here, we can go to this example. I'm not going to go over this right here because, what am I trying to say? That is before market open. Sorry, I couldn't think of what I was going to say. And this is overnight session. So right here, whenever market opens right here, look at what happens. We don't respect it. So we go down to the 5-minute chart. Notice, this is not market. This is London. But right here, you see we have displacement. And we absolutely run through these. So I trade New York session, so I wouldn't even be involved here. Whenever we run through all these, that's telling you what? That the draw is probably this high. So whenever we come back down, failure to sweep a low. So now we have equal lows. But then 720, we have huge displacement through this hourly fair value gap. Huge displacement on the 5-minute chart running through the hourly fair value gap. So that is telling you what? You want to go to the hourly chart and identify the next high after this fair value gap, which is what? pretty much relatively equal highs right here. So now we have the draw on liquidity identified before New York session opens. So whenever you open the charts, or when New York opens, which is right here, we have already swept that. We have huge displacement higher. That is showing that the draw is still higher. So you go to the higher time frame, find out where the likely draw is on that higher time frame, because we've already ran this hourly imbalance. Price is not going to sweep this buy side and then just dump, right? You have to think logically and actually not overcomplicate everything. Why would the market run through this bearish PD array, sweep buy side, just to reverse the whole way down here and take out all these lows? It's not going to. That is where a lot of people fail. They think that just because we swept buy side liquidity or sell side liquidity, that the market is going to reverse. That's not the case. You always have to understand what the likely outcome is. So whenever we run the bearish fair value gap, take buy side, what happens after that? We have to come back down, or we have to target internal liquidity, which are fair value gaps. I don't know if let's pull up the ES actually really quick. So, okay, no, neither of them come down into a hourly fair value gap. But why would we run this fair value gap, close above it, take buy side, just to come the entire way back down to sweep all these lows? It could happen. It could happen, but why would the outcome do that? It just doesn't make any sense. That's why you have to simplify how you are finding the draw on liquidity. So let's go somewhere in the chart. Right here. Right here. No, that's market. Okay, right here is right before market open. So right here we have a bearish fair value gap. Right here we have a bearish fair value gap. Look, we close above it. Let's go to the lower time frame. We're going to pull this back so I don't lose my spot. This is 3 in the morning, so London session. Looks like we're displacing through it. So we displace through it, but notice we displace back through it. So did we take a high on the hourly chart? No, failed to take that swing high. So whenever this candle closes above, your eyes should draw to the next candle. Notice this candle closes back inside of it. Okay, these two candles close back outside of it. Huge dump back through it. So you always need to be waiting for confirmation if you're trading before market open, right? If it is before market open, it does not always hit the draw on liquidity. That's why I'm not even up during London, but I wouldn't trade London unless I studied London, right? I've only studied New York session. So right here, this is 7 in the morning, when 7 dumps back through this with another fair value gap, I get rid of this one. My eyes draw to this fair value gap, right? We just took this low, so the next draw becomes internal, right? This is the fair value gap you want to be looking at. So we go to the 5-minute. Notice no candle closures on the 5-minute above it. This actually looks extremely ugly, but notice we dump back down. Wow, that's actually huge. That had to have been news. No, it wasn't. That was 10:30. But anyways, you see we hold the fair value gap on the 5-minute. No displacement through that fair value gap on the 5-minute. That is telling us that the draw becomes lower. And what do you see right here? Smart money needs to pair their orders above a high. We have a high right here. We are pairing orders inside of a higher time frame PD array. This is, I don't want to get into it, but this is where turtle soups come into fruition. I'm just going to leave that at that. So, man, I love, never mind, I'm not going to get into it, man. Anyways, we can draw our eyes right here. Fair value gap. Let's pull this. This is going to be the last example because it's so simple. If you don't understand this, you're just not, man. Okay, so right here, hourly fair value gap. No displacement through. Look at all these wicks in here. What is that telling you? We want to hold this. So we have all these wicks inside of here. We have displacement out. We come back down, right? You're not taking any positions. We just swept this high. We just swept this high. So you're not buying this fair value gap. You're waiting to see what the market wants to do. So we swept that buy side. What does the market need to do now? Pair orders. Pairing orders inside of what? A higher time frame PD array. Are you starting to notice? I'm not going to get into it. Never mind. Anyways, no displacement through this fair value gap. So market doesn't open, or market opens right here. We dump straight to it, but not through it. We hold it. Come out of it, come back in, displacement out to take this high, displacement lower, not through the fair value gap though. That is showing you that the draw is still higher. Are you understanding how to find the draw and why this is so simple? It's all about the fair value gaps, and if they are holding, the draw becomes either higher or lower. That's the video. It's super simple. If you can't understand it, go to the free Discord, ask me questions. I'll be in there. I gotta go to the gym. Peace out, everybody.